Good morning, dear friends. Today we are going to start a new topic, which is a very important topic called the time value of money. This is very significant for all the financial decisions. I don't think so that in any corporate world, the financial decision can be taken without understanding the various facets of the time value of money. As you know, that the main objective of the financial management is to maximize the wealth of the shareholders. It means all their efforts are directed towards the achievement of this particular objective of maximization, means how to maximize the wealth of the shareholders. So a person who is a finance manager in the organization, in its pursuit to achieve this objective of wealth maximization, this finance manager will have to take several decisions. The decisions may be financial decisions, they may be investment decisions, they may be dividend decisions. And while taking decisions, he will have to make use of this time value of money, without which I think he will not be able to achieve the objective of maximization of the wealth. I'll just make this point clear. I'll just try to explain it with an example. You assume that some machinery, some old machinery has to be replaced by a new machinery. Means old machinery is there and a decision has been taken that this old machinery has to be replaced by a new machine, and for this replacing the new machine there are three options which are available. The three options are in terms of machine A, machine B and machine C. It means any of these three machines can be put. Only one machine has to be replaced. It means this old machine will have to be replaced either by machine A or by machine B or by machine C. So these three options are there, and a finance manager will have to evaluate the proposal which machine is to be put in respect of the old machine. Now he will have to evaluate the proposal. The cost of these machines would be different. The life of these three machines would be different. The repair and maintenance of these three machines would be different, or you can say the benefits and the cost which is associated with each of the machines would also be different. Now the question arises, how to make a comparison and come to the optimum decision? It means you will have to evaluate the different parameters of these three machines. Now when I say that the cost is different, it means the cost of the machine would not be the same. It means all the machines would be having the different cost. Similarly, the benefits which would be arising from the machine would also be different. Not only the magnitude of the benefits, when I just say the benefits would be in the form of cash inflow and the cost would be in the form of cash outflow. For example, if the benefits they are accruing from the machine, from these three different machines, they would also be different. Not only the magnitude of the benefits in respect of all the three machines would be different, but also the timing of the benefits, the timing of the cash inflow in respect of these three machines would be different. It means it's not possible to compare the benefits of these three machines, because a cash inflow of say rupee 1 cannot be compared with the cash flow of rupee 1 which is being received 2 years later in respect of machine B or in respect of machine C. It means the amount of rupee which you are getting today, for example, the amount of rupee which you are getting in terms of the benefits from machine A at period 1 cannot be compared with the amount of rupee which the machine B is giving at a period 2. It means for comparison purpose, we will have to have some factor, and that factor is called the interest factor. So if we just add up the interest factor in respect of the benefit which is accruing to me at a period 1 and the same rupee which is just being accrued to me in respect of machine B at the end of period 2, just to make the comparison of rupee 1, I will have to add the interest factor, and which is very crucial factor and exclusive concept of the theory of finance, and this is also, you can say, known as the time value of money. It means the main determinant for the time value of money which would make us possible to make the comparison between the different cash flows, which will be in the form of cash inflows or in the form of cash outflows. That can be made possible only when there is some element of interest factor is taken into account. So I can say that interest factor is one of the crucial and exclusive concept of theory of finance, and is also known as the time value of money. Now we'll just try to understand the concept of time value of money. What exactly is the concept of time value of money on which it is built? The concept of time value of money, I can say, is that if you just presume that a bird in hand is better than two in bush. It means whatever you have today is better than what you are likely to get the same amount tomorrow. If you are just given the option to get 1 lakh rupees right now, or to get that 1 lakh rupees after 1 year, naturally you would like to have the first choice, that is, you would like to have 1 lakh rupees today. So the preference on the part of the person, the preference for the current money as against the future money is known as the time value of money. So the concept of time value of money is applicable as a concept which tells us the desire on the part of the person. Here the person doesn't mean only individual person. I just want to tell you that the time value of money applies equally, that too in equal strength, whether you are talking of individuals or you are talking of corporate world, anything. So the preference for the current money as against the future money is known as the time value of money, and the concept of time value of money is applicable in equal strength to the individuals as well as to the business units or to the corporate world. Now, why there is a preference for time value of money, that we just try to understand with the help of a slide. The time value of money is there for 3 different reasons. Number 1 is the future uncertainties. Number 2 is the presence for the present consumption, and number 3 is the reinvestment opportunities. So these are the 3 various reasons or various factors which require the preference for the value of money right now. Number 1, the future uncertainties. The future is very uncertain. For example, you have got some money and you have parted with this money to somebody else. It means you have just lent this money to somebody else. It means there is a future uncertainty in respect of future money. The person to whom you have just given the money may not give you the money back, or there may be default on the part of some other person in respect of the interest. So future money means uncertainty is there when you just give the money. So that is also one of the reasons why people want to hold the money right now. Number 2 is the preference for present consumptions. You will find that in most of the cases, if you have got the money, you would like to have this money for the present consumptions. However, the amount of consumption, that is a very subjective thing. You may like to have consumption right now. Some of the people may be able to postpone it, so that is very, very subjective matter. But when you have got the money, you would like to have it for the present consumption, and if you just part with the liquidity, you part with the money, at least to that extent, your desire for present consumption shall be postponed, and will be, you can say, deprived of this facility, this right of the present consumption. The third is the reinvestment opportunities. When you have got the money, you can reinvest it. When you reinvest it, naturally you will get the return. But once you don't have the money, then the opportunity to get the returns by way of reinvestment shall not be available to you. So these are the three reasons, you can say: the future uncertainties, the presence for present consumptions, and the reinvestment opportunities. They call for the time preference for money right now. Now we'll just try to understand this preference for the money right now by taking an example. For example, firm A is selling some machine to somebody for an amount of rupees 1 lakh. Now, firm A, that is the seller firm, it says to the buyer, who is B, this firm says that you have got the option either to pay 1 lakh rupees right now, or this option has been given to the buyer that let this 1 lakh be paid to the firm after 1 year. It means number one option, pay the amount right now, or pay it after 1 year. Naturally, where this option is given to the buyer, he would like to pay that amount after 1 year. It means when he chooses that particular option, the reinvestment opportunity which is otherwise available to firm A, that would not be available. Now, if there is no option at all, and you presume that 1 lakh rupees is given to firm A, naturally this 1 lakh rupees can be invested by the firm A in its own investment, or even if they just make a FD of this and just get a return of 10%, naturally this amount will become 1,10,000 after 1 year if I just choose to, or if the firm A chooses to make a deposit of 1 lakh rupees in a bank. Or otherwise, naturally, it's a business firm, it would like to reinvest this money into their own business. So I mean to say that if this option is given, naturally this option is given to B, B would not like to pay the interest, B would not like to pay this amount right now, and he will choose to pay the amount after 1 year. It means in between the reinvestment opportunity would be lost to the firm A. So I mean to say that these are the three reasons why people just have the preference for the money for the present context. It means presently they want to hold the money instead of having that money at some future period. So this is the way the time value of money works, because interest is an element which determines the rate of return which an investor can earn by reinvesting its present value. So you can say the concept of time value helps in converting the different rupee amounts arising at different points into equivalent values of the particular point of time. So this is only with the help of time value money you can convert the different rupee which shall be arising to you at a different point of time into the equivalent value, so that you can make the comparison, and this equivalent value can be expressed in either as a future value. So the equivalent value can be expressed in the future value. For example, if you have got the money right now and you want to calculate the future value, naturally the future value can be calculated by taking into account the interest factor. It means you will have to add the interest factor in the present value. For example, if I just say I just want to invest rupees 1000 and the rate of interest is say 10%, rate of interest is 10%, what would be the future value of this money after 1 year? Naturally, what would be the value of money after 1 year? The present value is 1000 and the rate of interest is a 10%, so the future value of the money would be 1000 plus 1000 into 10 divided by 100. It means the future value would be 1100. It means the amount of money of 1000 is equivalent to 1100 after 1 year, taking into account the interest factor of 10% per annum. This is the way we can calculate the future value, and if we have got the future value, we can discount it to the present value by discounting the interest rate. So interest rate is a very crucial element which can convert the present value into the future values, or which can discount the future value in the present value. So two important things are there in the time value of money. One is the compounding factor and another is the discounting factor. Compounding means when we want to calculate the future value, as we have just done in that example, and discounting means that we have got the future value and we want to calculate the present value, so we can discount it by the rate of interest. So what is common in both the things is the rate of interest. In the first case we are just compounding, and in the second case we are discounting with the rate of interest. So this is the way it works. Means we can calculate the time value of money, so that the different series of cash flows, which may be in the form of cash inflow or in the form of cash outflows, can be made comparable. So we'll just try to learn these compounding techniques and discounting techniques in our subsequent discussion. Thank you very much.